There's so much liquidity in the marketplace. People have money to spend. They're spending money. But I will tell you, I don't profess to be an economist. I'm wrong all the time. I thought COVID was going to be the bellwether for this crash, and it wasn't. And sure, a lot of businesses suffered. A lot of hospitality got killed. A lot of hotels, restaurants, and shops went out of business. But the multifamily did just fine. Yeah. Other asset classes didn't get help. We got help. I got hundreds of thousands of dollars in rent relief money that our tenants were able to pay their rent with.
I have a dream.
With great power comes great responsibility.
I could do this all day.
This is it. Don't get scared now.
They may take our lives, but they'll never take our freedom.
Cinderella story out of nowhere.
It's in the hole. That the only thing we have to fear is fear itself.
Capital hacking begins in 3, 2, 1.
Rod Khleif, welcome back to the big show, Capital Hacking. It is great to have you here, my friend.
It's good to be here, brother. I appreciate you having me. Let's have some fun today.
For the listeners who didn't pick up the first episode we did together, would you mind reminding them about who you are, where you live, and what you do, brother?
Sure. I'll be real brief. So I'm a multifamily real estate investor. I'm an immigrant, immigrated to this country when I was 6 with my brother Albert, my mother's Vancha. Really struggled growing up, wore close in the Goodwill and the Salvation Army all the way through junior high school till I finally got a job and bought my own clothes. My mom was the entrepreneur. She actually babysat kids so we'd have enough money. With her babysitting money, invested in the stock market successfully and also invested in real estate. And so her first real estate acquisition was the house right across the street from us when I was 14. And then when I was 17, she told me she'd made $20,000 in her sleep on it. And I'm like, you made 20 grand? You didn't do anything? This is back when 20 grand was a lot of money. And I said, screw college, I'm getting into real estate. So I went and got into real estate. And fast forward to today, I've owned a couple thousand houses that I've rented long-term. I own thousands of apartment units. I've built 27 businesses. In 2006, my net worth went up $17 million while I slept. And you might say, wow. And I said, wow. And I got a head so big, I could barely fit it through a door. I thought I was a freaking real estate god. And when that happens, God will give you a nice little reckoning. That was 2008. I lost that 17 million, a lot more. I lost $50 million in 2008. And what I'm known for on my podcast when I teach is really around mindset, the mindset it took to have 50 million to lose in the first place, and then the mindset it took to recover. But I think we're going to talk about something else today. We're going to talk about the state of things out there. You said you want to talk
I'm excited about that.
Yeah,
the state of the union, or let's talk about the state of the economy, the markets, and investing. And those of us who are listening today, what we really enjoy, Rod, is your passion. I watch you on social media and your passion for teaching. Now, you do teach. Let's talk about the framing here today. So you're an active investor yourself, but you frame your teaching around active or passive investing. And what is it like?
Both. No, I teach both. I do boot camps regularly. I've actually have one on October 15th and 16th, but that'll probably have passed by the time this airs. But I do them every quarter. Yeah, I don't sell anything in my boot camps. And by the way, if you're listening to this and that has passed and you're interested, if you DM me on any social channel, you let me know you heard me on Josh's channel, you can come for $97 and I don't sell anything there. So it's a no-brainer. If you're interested in learning this, and the reason I bring that up is even if you're going to invest passively, why would you give your hard-earned money to someone if you didn't have some basic understanding of what it was? And that's why a lot of people come to my boot camp just to learn the business well enough to invest passively and not lose their money. And I will tell you, I think the last couple of years, there's been a lot of greed and a lot of skinny deals have been done. And a lot of deals have been done with bridge debt. And we can drill down on any of that. Why I think there's going to be a reckoning with some of that stuff, because I really believe there is. And again, I've got 1,200 students around the country. My students now own somewhere upwards of 90 to 100,000 doors that I know of. Wow. I've been teaching 5 years. My podcast just broke 14 million downloads.
Congratulations.
Thank you. If you're interested in multifamily, come listen to my podcast. It's called Lifetime Cash Flow Through Real Estate Investing. And I love it. And I do clips every week on there about mindset, a 5-minute clip. You give me 5 minutes a week, I will juice you, I promise. They're called Own Your Power. So there's hundreds of them there. And so, my love is talking about mindset and psychology, but my students are killing it. We're doing great personally. We've got a beautiful asset under contract in Nashville right now. And so it's not just a do as I say, not as I do kind of a thing.
That's a great compliment to your message. Your message is did it, lost it, did it again.
Yeah.
Teach it a lot and still do it.
Yeah,
I was going to summarize you.
Yeah, and I was going to say, I built 27 businesses. I don't call them failures. That 50 million, that was a seminar. That was an expensive freaking seminar. I built 27 businesses, several worth tens of millions of dollars. Most are spectacular, flaming seminars, okay? But, we fail our way to success. Josh, I got to meet the billionaire. Yeah. I got to meet the billionaire owner of Spanx, Sarah Blakely, the women's undergarments.
She's impressive,
right?
Yeah.
Oh, she's cool. And a cool woman. Started with $5,000 and now she was in Forbes. She's net worth over $1 billion. But she told me that her dad used to ask her and her brother once a week, what have you failed at this week? And I thought, what an awesome freaking question to ask your kids so they don't fear failure. So if you're listening, if you're listening and you're afraid of failure, I'm going to tell you, fear being in the same place you are right now a year from now, unless you absolutely freaking love where you are right now. So that's what that's my advice to you.
Well, no, I mean, this is impressive to get a chance to, first of all, you are a great motivational speaker as well, which is cool.
Thank you.
So let's talk about the facts.
Yeah.
All right. We're in the end of the year here, almost Q4 of 2022. And we've been through
5 consecutive interest rate increases. Okay.
Incredible.
5 consecutive. Powell has said that another 125 basis points is on the table for this year. It's another 1.25%. Interest rates are now well above 6%. We got debt at 3% a year ago. It's the highest since Freddie Mac's the highest since the 2008 recession. And new home sales are drying up and falling off a planet. And I will tell you, people like billionaire co-founder of Carlyle Group, David Rubenstein, says it's going to be very difficult for the Fed to reduce inflation with the interest rates. And I believe the same thing. It's because the inflation is because they threw so much money at this. They printed money like it was free. And that's the problem is there's too much cash out there. And it's going to be, I think we're definitely going to be in stagflation for a while. And, the Dow is below 30,000, which is pretty significant as well, which is really the worst level. Investor sentiment's the worst since 2008 as well.
Let's talk about a few things. This idea that David Rubenstein said the Fed, it's going to be difficult to reduce inflation by interest rates. Now,
correct.
You and I have been watching the regular news, and it says if they raise the interest rates, it'll bring inflation down. That's been the argument.
Right.
You just said you and other smart people are not sure that's accurate. Why? Teach us for a moment.
Because there's so much liquidity in the marketplace. People have money to spend. They're spending money. But I will tell you, I don't profess to be an economist. I'm wrong all the time. I actually thought COVID was going to be the bellwether for this crash, and it wasn't. And sure, a lot of businesses suffered. A lot of hospitality got killed. A lot of hotels, restaurants, and shops went out of business. But the multifamily did just fine. Yeah. Other asset classes didn't get help. We got help. I got hundreds of thousands of dollars in rent relief money that our tenants were able to pay their rent with. But there are so many factors that are happening right now. According to another economist, Kevin Hassett, families are losing $460 a month right now. And this is another economist predicting that home prices are going to drop by 30%.
What do you think about that?
I'm convinced of that one because if you take a look at the interest rate a year ago and you take a particular price on a house, you look at what the payment is, and then you look at today's interest rate and what the payment would be on the same price house, you're going to have to drop the price 30% to match it. And do you know, by the way, this one will blow your mind. And listen, I'm not trying to scare anybody listening or watching. With crisis comes opportunity. Everything's going on sale. There's going to be incredible opportunity. Okay. But here's something that'll scare you. There are 20 million families in the United States right now that are behind in their utility bills. 20 million families.
That is surprising. Wow.
Yeah. That was a month ago. That was on the news. I think when things are going to get ugly is right after the midterms. So there's a big political influence on major media. And I think after the midterms, it's going to be the gloves come off and it's going to seem really ugly.
Okay. So to translate, you're saying once the elections are done, they'll be a little more brutal in their assessments.
Exactly.
So that you don't have to prop anybody up. Gotcha.
Exactly.
So you've done a good job of explaining why you should be bearish and defensive going into 23, which is exactly the right and maybe the most common prudent advice I'm hearing, which is great. Thank you for sharing that. Talk to me about skinny deals in multifamily.
Sure.
You shared that a minute ago. It's a great expression. Why did you call And what did that look like last year?
Yeah. Warren Buffett's famous quote, be fearful when others are greedy.
Yeah.
And a lot of greed the last couple of years. And he says, be greedy when others are fearful. I'm going to tell you the fear is coming. I promise you. Okay. It's coming. They're going to make you think the world is falling apart. I mean, they already do. Don't get me started on the freaking crap they put on the news, but I lost the question.
No, just as far as skinny deals last year.
Oh, skinny deals. That's right.
Yeah.
So there are a lot of operators that got into the business that were doing anything they can to take deals down. down. And
Yes.
and including using bridge debt, because Fannie Mae and Freddie Mac dropped their loan to values because they see the writing on the wall. They've been around forever. They know what's going on. In fact, we're close. I told you we've got a Nashville deal under contract right now. We're raising money for $19 million for a $33 million deal because we're getting
raise.
Right, because we're getting 60% loan to value debt. Okay, 10-year fixed rate, low interest rate debt. But we had to go 60% to have it make sense and to give us a comfort level. And I will tell you that a lot of operators use bridge debt these last couple of years to take deals down, because the higher the loan, the better the returns look for the investor. Right. The less you have to raise, the better returns you're going to show. We're still showing upwards of 10% cash on cash, 16 to 19% IRR, and 20 to 22 AAR on this deal, which is astounding based on the 60% loan to value debt. But the point is, a lot of people were doing 80% loan to cost debt with bridge loans, 75% loan to cost and or loan to buy. And bridge debt is very onerous debt. It's short term to start with. Okay, it's typically 3 years. You might get 3-1-1. Like 3 with 2 1-year extensions, but it's adjustable rate debt. And in the most recent past, they made you buy a rate cap for a 2% rate cap, and they were very expensive. But let me tell you something, and you know this, Josh, if you get a 2% interest rate increase on your debt and you're in the multi-million-dollar asset, that is a big deal. Okay, that alone is a big deal. But some of these guys didn't even get rate locks. They're really in trouble. But here's the other problem. A lot of these guys were super aggressive with their exit caps, meaning when you do a pro forma on an asset, you have to estimate what the cap rate's going to be when you have a liquidation event. Either you refinance or you sell. And a lot of these guys were super aggressive with their exit caps, and they're not going to be able to refinance or sell because the value is not going to be there. Let me give you the definition of a bad day. A bad day is you've got a nice cash flowing asset. And in fact, let me back up and pre-frame this. If you look at a graph of interest rates in 2008 and 9, when the interest rates climbed because of the crash, and you look at cap rates, it mirrors the interest rates. So cap rates are going up. It's inevitable. And here's the definition of a bad day. You've got an asset that's cash flowing and the cap rates have gone up and you can't get the value you need to refinance because you got a high loan to value loan. And that's a bad day. And a lot of this debt's going to come due, I think, in the thick of this. But as far as I'm concerned, that's opportunity for us. There's going to be deals.
Very interesting. Yeah. First of all, the reframe, I love the way you teach. It's good.
Thanks.
It's really good. To go back a couple of years ago when you and I were seeing deals from the normal syndicator, we may not have been, you would have known this, but an average listener watching this may have not recognized why the IRRs were so high. You're saying it was because they were very little equity to debt. So it was low debt.
No,
high debt,
low
equity.
Low equity, correct. Because you're able to increase the numbers, the returns rather. You're able to increase the returns look better, the less equity you put in a deal, but it's much more dangerous. And a lot of these guys, I was looking at offering memorandums from some of these operators, and there's no cash reserves at all, no operating reserves. We do a minimum of 6 months expenses, operating reserves that we don't touch. That's just in case what hits the you-know-what. And a lot of these operators didn't do that. A lot of these operators never been through a downturn where asset management is critical. And they're not really on top of their KPIs, on their weekly KPIs as it relates to managing that asset. That's going to be a problem as well. And I think there's going to be a lot of opportunity in my space. I'm excited about it. There are deals now. Like I said, we're closing on our Nashville deal. If you're an accredited investor, text the word partner to 72345 if you want to check that out. There's still some slots left. I'm sure there will be in a couple of weeks. I had to leave the country for almost a month, and so I'm a little behind on the raise. But if you text partner to 72345, it's a screaming deal. So please check it out. And I know I'm bearish. and
let's throw a couple not disagreements, but arguments that I've heard 100 times that have premises and truth.
Sure.
So what do you believe about the shortage of residential units and or
there is absolutely a shortage of housing, no question. But people have to survive. And I'm going to tell you, I think the A and B class assets are going to definitely do better in what's coming. Because I'm going to tell you, when you take $500 out of somebody's income because of inflation and gas, which is what this guy estimated, and I don't even know if that's even enough, honestly, but you take that out, that kills some families. And like I said, 20 million families behind in their utility bills. There was an article about 3 weeks ago in Forbes that they surveyed a bunch of companies, and 51% of the U.S. companies are expecting layoffs. 51%. Okay. And some of them have already started. A lot of them have been buried in the news that you're not even seeing, but that's all in my opinion, going to come to light. And some big players, smarter than me, have said it's going to be a much bigger crash than people. Elon Musk says they're lying. It's going to be a bigger crash. That's a quote. Okay. Donald Trump, love him or hate him, says he warns the U.S. economy could reach the levels of the Great Depression. Now that's even Robert Kiyosaki's been saying this, the author of Rich Dad Poor Dad. It's going to be a big one. I think that
another debate. Yeah. No. So you think it is going to be big, and those are things that you see on TV. I definitely have heard those. What about the other debate against house values dropping, which is replacement costs?
I promise house values are going to drop. I bet anybody any amount of money on that one. Okay. That one I'm certain of. Am I certain it's going to be a depression? No. I think it's going to be, for sure. We're already in a recession, technically. Is it going to be a depression? I don't know, but I think it's going to be ugly. But I'm convinced housing is going to drop. It has to. People can't afford it. So they're going to have to adjust the price because of the interest rates. Now, if the interest rates come back down next year, which a lot of operators are saying is going to happen, then maybe they'll recover quickly. But I think it's more about the fact that there's going to be a lot of layoffs, that companies are going to tighten up, people are going to stop spending, and it's just going to snowball. They're saying it's going to be global too. It's not just going to be the United States. China's in deep stuff right now. There's stories about their people not able to take money out of the banks, and these big real estate companies that were building buildings, they're even tearing them down, that they basically is almost like a Ponzi scheme. There's a lot of unrest economically right now. They're Russia shutting off the tap for energy. I was just in Europe and I was talking to the taxi drivers. We were in Denmark, Sweden, Norway, and Ireland. And they're all like, yeah, our energy costs have doubled and some people, they can't afford that stuff, man. But anyway. No. Yeah.
Let's talk about
let's talk about the opportunity. Thank you.
Let's talk about the opportunity.
So sides, yeah.
All right. So we're going to talk about the opportunity. Let's even use a current deal that you have. You have a Tennessee deal.
Yeah.
Where did you comp set it? Did you compare it to 2 years ago?
Oh God, no.
Underwriting what are you
very conservative, very conservative. Okay, I lost $50 million. Hit me once, shame on Rod. Hit me twice, hit me once, shame on you. Hit me twice, it's Rod's fault. Okay, so I'm very conservative, and we stress test a deal like crazy. Okay, and we look at our break-even occupancy. We're very conservative on the exit cap rate for when we want to have a liquidation event. And a lot of guys will bump up their cash on cash returns by having a refinance in year 3 or 4. We didn't even have to factor that in our calculations. That would just bump the return if we did. We're at already upwards of 10% cash on cash without it. But here's the thing. This particular asset is almost all 3-bedroom units, and the remaining 2 bedrooms can be converted to 3 bedrooms with very little work. They're the right size already. And that's really desirable for this particular area. The demographic has families, they have kids. It's a beautiful asset built in the 90s. It's 145 doors, really gorgeous looking property. There's an opportunity to put a bunch of more garages in. There's a waiting list for garages. There's some garages there and there's room to put more in. We're going to do that. And there's just the market rent for these 3 bedrooms is about $2,500 a month. They're right now at under $2,000 a month. There's a huge bump that we can have there. And like I say, it's just a great deal. I'm going to tell you, in the last year, I've only bought one other deal. Okay, I bought a San Antonio asset, 296 doors in September a year ago. We've been seeing what's been going on, and my conservative underwriting, nothing met our underwriting. And so we're very excited that we've got this other deal now that penciled out. People are like, should I wait to buy? I'm like, no, I'm buying right now. Now, we kissed a lot of frogs to find that deal. Now's a great time to learn the business as well, okay? If you're going to capitalize on what's coming, you need to be up to speed. If it's going to be multifamily, for God's sakes, come to one of my boot camps. But if it's single family, go learn that. If you're going to buy businesses, go learn that. You're going to invest or trade in the stock market, go learn that. But don't wait. Get up to speed right now. Other thing, conserve cash. Don't spend a lot of money right now on conserve your cash, because cash is king in a downturn. I'm in a lot of cash right now, so I can capitalize on it. But even if you don't have a lot of cash, the ability to raise cash is also really important. At my boot camp, I teach strategies for keeping the fear down with your investors so that they recognize that opportunity is coming, and if they pounce on it. Anyway.
I believe that. So back to debt. What were you able to get agency debt?
Yeah, agency PMAX.
Because 60, you have a low LTV.
Yep, 60% loan to value. Now I had to go 5%, but still the deal it looks fantastic at 5% even. And I hate it because we're at 3.2 on the one we bought a year ago. It is what it is. I remember, listen, I've been around this a long time. I remember when I did backflips when the interest rate dropped to 7%. Okay, this is when I first started in the business 40 years ago, and rates were 18% when I got in the business. And so we were like, holy shit, we can get 7%. This is incredible.
That's awesome.
That's what we're seeing. We're already at 6. So, it could go up. Who knows? It could go upwards of 10. again with if that's the only mechanism that they're able to utilize. Now they are going to start, I forgot what they call it, where they start pulling money out. They stop buying the bonds and they actually become net sellers instead of net buyers of treasuries, which the whole thing is just from one pocket to the other. It's all a bunch of paper moving back and forth.
It's very surprising how it all really works. And it's probably above all our heads, but that whole idea of they call that quantitative.
That's it. Quantitative easing. And they're going to flip that and it's going to be, I forgot what the reverse of it is. Do you know what it's called?
Tightening, maybe?
Tightening. It is tightening. That's exactly right. Tightening.
And the idea being that the biggest thing, you said it, Carlisle said it, the Fed lowering the rates is not enough.
Yeah.
Really what they're going to maybe do is act intentionally or unintentionally start a recession that's deeper, right? Now, there's something to the fact that, what do you think about the fact that if they were to intentionally have recession, does that mean that it's shorter or longer?
I think a lot of smart money thinks that there needs to be a reset with this. There really does. There's so much debt. The debt is insane in this country. They had to print more money this month to pay the interest on the debt. Okay. And then you've got, we won't get started on go down that political rabbit hole, but paying off almost $1 trillion in student debt. Come on. Printing another $1 trillion freaking dollars when we've got rampant inflation to try to get some votes. I mean, good Lord, you can't make this stuff up. But
so let me make that a linear thing. You're saying that if you pay off a student debt, you need to actually sell bonds and create cash somehow.
That money's coming out of thin air.
Money.
No, they haven't said who's paying for it. I can tell you who's going to pay for it. We are. My daughter who worked her butt off so she didn't have student loan debt is going to be paying for somebody who didn't. And that doesn't sit well. And of course, all that liquidity again creates more inflation.
Which is what they say. It's not so, and then you worry that the liquidity, they're going to have to take money out of the system somehow. So
that tightening,
it's awesome to get to know you a little bit better every time.
Oh, thanks, buddy. Listen, if I could just say something real quick.
Tell us.
Yeah, no, just if you are interested in learning my business, the multifamily business, text my name, Rod, to 72345, because I do a boot camp every quarter there. I don't sell anything there, and you can come for $100. If the price has gone up, like right now, I think it's upwards of 400. Just DM me on any social channel. I'll get you that $97 price. Just let me know you heard me on this podcast. I'll get you that $97 price. But I just wanted to mention that. I appreciate that. And
that's awesome, Rod.
Yeah, appreciate you, brother.
We appreciate that. And so in your boot camp, just to teach me real quick, you're going to go through underwriting?
Every part of the business, finding, picking a market, evaluating a market, finding deals, evaluating the deals, doing the due diligence on the deals, underwriting the deals, financing them, raising all the money you need for them, syndication, joint ventures, property management. I mean, everything, soup to nuts. It's drinking through a fire hose.
For how many days?
2 days, 2 full days. And I don't sell anything. It's me the whole time.
The whole time. Every component.
Except the syndication and the finance piece. I bring a loan broker in to do the finance. I could teach both, but I bring them in just to change it up. So I bring a loan broker in. I bring in a SEC attorney in to do the syndication.
Is that Sarasota? Where do you
I live in Sarasota. This is actually in my compound where I live. We built a video studio here when COVID hit and we had to go virtual. But yeah, I do live events once in a while. I had 850 people in Denver a couple of months ago, but the next couple will be virtual. So you can do them at home.
Oh, the boot camp is virtual?
Oh, yeah. It's at home. Yeah, you do it at home. Yeah. It's live. You can ask questions and everything, but it's virtual. I do it right here in the studio.
You're an impressive dude. Keep up the good work. We'll stay in touch and we'll follow along.
Thanks, my friend. Take care, man.